Hello everyone. Now we will talk about the budget amendments that was brought in by our Honorable Finance Minister. This video will be more for a professional where income tax related amendments would be discussed. Income tax related amendments would be discussed. The first one that we have got is the concept of updated return. It is the concept of updated return. What is this updated return? There are scenarios whereby the assessees might make some kind of mistakes. Yes, then we can say no, we have got a revised return. Yes, the revised return time limit is now, right? Forget about the extension that we have got for COVID. Otherwise, it is 3 months before the end of the 11th assessment year. That means it has to be filed before 31st of December. This updated return will be applicable and a section was introduced, subsection in fact, section 139 subsection 8A, which states you can file your updated return within 24 months from the end of the 11th assessment year. This is applicable whether or not you have filed your original return, that is original return or belated return or revised return, whether or not you have filed. However, this is applicable only upon payment of additional taxes. This updated return concept was introduced to minimize the litigation. If the assessee himself accepts that he has missed out some income or claimed excess expenditure, then this return can be filed. However, this return cannot be filed if it is going to be a loss return or if it is going to decrease the total income or increase the refund for a return that has already been filed. Let's say an assessee has already filed a return under section 139(1) with a total income of, let's say, 50 lakhs. Now he is going to file an updated return which is going to have a total income of 49 lakhs. No, not possible. So it cannot decrease your total income, it cannot increase your refund, and it also cannot be a loss return. Now we said there should be an additional tax that has to be paid. This additional tax would be at the rate of 25% of aggregate tax and interest payable. If this is filed within 12 months from the end of the 11th assessment year, and it would be 50% of aggregate tax and interest if it is filed within 24 months. So you have to pay your tax and interest plus this additional tax, which is 25% if filed within 12 months plus 50% if it is filed within 24 months. However, for an assessee where search or survey is conducted, then updated return cannot be filed. Or for an assessee for whom assessment is pending or assessment is completed, then again updated return cannot be filed. So this is the concept of updated return introduced by way of section 139 subsection 8A, and this is to minimize the amount of litigation. The next type of amendment that was brought in, I will say, in fact, we have got a new thing that was introduced about taxation of virtual digital asset. Now this virtual digital asset will be taxed at the rate of 30%. The income from this will be taxed at the rate of 30%. The only deduction that can be claimed is the purchase, cost of purchase. No other deduction can be claimed. If at all the assessee has incurred some kind of expenditure, that cannot be claimed. If there is a loss which the assessee has got, that loss also cannot be set off against this virtual digital asset. And let's say one person is giving a gift of virtual digital asset to another person, then the tax has to be then for the recipient, we'll say the gift for the recipient it would be taxable. It's like if you gift an immovable property, for the recipient it would be taxable. Same manner, if you gift this virtual asset, for the recipient again it would be taxable. Again, new section introduced for TDS, which should be at the rate of 1% on this virtual digital asset. There will be a TDS which will be at the rate of 1%. Next amendment that we have got is under section 14A. What is 14A? 14A disallows any expenditure that has been incurred for earning an exempt income. So you have got an exempt income. To earn that exempt income, if at all you have incurred some expenditure, that expenditure would be disallowed. Say for example, you have got an agriculture income which is exempt under section 10 subsection 1. Now, any expenditure incurred for earning that agriculture income will be exempt. Any expenditure incurred for earning the agriculture income will not be allowed as deduction. Now, during a year, suppose you have not earned the exempt income, can there be a disallowance under section 14A? There were plethora of case laws which said, if the assessee has not earned any exempt income, the expenditure cannot be disallowed. So, to overrule that judgment, an amendment was brought into in section 14A which says, 14A disallowance should be applicable even if the exempt income has not been earned during the year. That means if an expenditure has been incurred, but you have not earned an exempt income, it will still be liable for disallowance. Then, this is quite an interesting amendment that was brought in under section 40 subsection A. 40 subsection A disallows any income tax that you have paid. So if at all you have paid an income tax, it disallows. The question is, if you pay surcharge or if you pay cess, can you claim it as deduction? For example, let's say assessee has got only a assessee has got only PGBP, and for that PGBP assessee has paid taxes. Let's say the moment you pay income tax will also be liable for cess at the rate of 4%. Can you claim a reduction of cess? Answer should be ideally no. But there were assessees who claimed reduction and there were case laws also which allowed. To plug that loophole, there is a retrospective amendment that was brought in which says now cess and surcharge will not be allowed as deduction. This government is very careful in bringing a retrospective amendment, and one of their the manifesto in their budget was to minimize the retrospective amendment, and this is one of the retrospective amendment they have brought, whereby they said cess and surcharge on the income tax will not be allowed as deduction. The next thing that we have got is under section 115 BAB. What is that? If there is a manufacturing company, domestic manufacturing company, then they would be eligible for 15% rate of tax. However, that manufacturing company should have commenced their production before 31st March 2023. Now, because of COVID, there could have been delay in the plans. Therefore, now they have extended the period from 31st March 2023 to 31st of March 2024. 1 year they have extended. Similarly, there is also an extension in section 80 IAC. 80 IAC is the section that is available for exemption in case of an eligible startup company. They should have been incorporated before 31st March 2022. Now that has been extended and said you can incorporate the company till 31st March 2023. Now, next amendment is under section 37. There was a circular that was issued in 2012 which said that if a pharmaceutical company has given some kind of benefits or some kind of samples to the doctors, then for that pharmaceutical company you cannot claim the deduction. Why? Because Indian Medical Council has said that doctors should not receive any gift. So doctors should not receive any gift. So from doctors can receive gift from pharmaceutical company. Therefore, if the pharmaceutical company gives no free samples to the doctors, then for the pharmaceutical company it will not be allowed as deduction. That was the circular that was given in 5/2012. Yeah, 2012 the circular was given. Now, there were questions that were raised whether this circular is valid in law or not. So some courts answered in favor of the department, some courts answered in favor of the assessee. Today it has been made a law where it says any benefit which is in violation of any law or guideline, then that expenditure will not be allowed as deduction. So any benefit which is in violation of any law or any guideline, then that expenditure will not be allowed as deduction. So here this will not be allowed as deduction. There is one more amendment that was brought in section 37. So section 37, as it stands today, it says if an expenditure is incurred which is prohibited by any law, then it will not be allowed as deduction. So the moment you start paying penalties, let's say GST penalty. Why do you pay GST penalty? Because you have not followed some provisions of GST. Therefore, it is prohibited by law. You paid penalty. It will not be allowed as deduction. If it is prohibited by any law outside India, so the act was silent and there were judgments contrary. So to bring on par, they have now said expenses will not be allowed as deduction if it is prohibited by any law, whether in India or outside India. That law could be in India or outside India. If it is prohibited, then that expenditure will not be allowed as deduction. Then next amendment is alternate minimum tax, something similar to MAT. This alternate minimum tax is applicable for all non-corporates. Now the rate of tax for MAT was reduced from 18.5% to 15%. Similarly, on that lines, AMT for a cooperative society, only for a cooperative society, not for others, only for a cooperative society, is reduced from 18.5% to 15%. That means for a company, MAT is at 15%. For a cooperative society, AMT is alternate minimum tax, is again at 15%. For others, AMT continues to be at 18.5%. Then the next amendment is under section 80 CCD, where the employer contribution would be allowed as deduction till 14% of salary for all central government employees. Employer contribution can be till 14% for all central government employees. Now the amendment is even for the state government employees, it can be till 14%. That means the central government employees and state government employees are on par, which is 14%. Others, the employer contribution can only be till only 10%. Then there was a circular that was the next amendment is under section 56. There was a circular. Now the circular has been brought into the Income Tax Act itself. Any amount received for treatment of COVID or the person died, so the family of that employee is receiving money from the employer on death. So employer pays to family of the employee. Employee died, employer is paying to the family of employee. Or amount received from any other person, not from employer, any other person on account of death. The third alone, there is a limit of 10 lakhs. It is exempt under section 56. So three amounts we have got. It was all in circular. Now they have brought in the Income Tax Act itself with a retrospective amendment. This is a beneficial retrospective amendment. So amendment, in section 56 is amount received for treatment of COVID. Employee died. Money is received from employer by the family. Completely exempt, whatever might be the amount. Any person died. Money is received from any other person, not from the employer. Then it is exempt to the extent of 10 lakh rupees under section 56. Similar amendment was also brought in under section 17, for perquisite. Then section 50C or section 43CA talks about a case whereby you sell an immobile property, the full value of the consideration or the amount that is taxable will be the selling price or the stamp value, whichever is higher. This is for 43CA that we have got, as well as for section 50. Similarly, we have got under section 194IA, which is TDS on immobile property, which is at the rate of 1%. Now, amendment is not in 50C or amendment is not in 43CA. Amendment is in section 194IA, which is now the rate of 1% on the selling price. Even if the stamp value is higher, you have to deduct the taxes only on the selling price. But 194IA has now been amended and says the proposed 194IA will now be 1% on the selling price or stamp value, whichever is higher. 1% on the selling price or stamp value, whichever is higher. So that also similar to 43C and 50C, they have brought and said it is 1% on the stamp value or selling price, whichever is higher. Next amendment is introduction of a new section, section 79A, whereby if there is an income that has been found out during the course of search or survey, then against that income, whatever the assessee has got as loss, it cannot be set off. So that means the total income includes any undisclosed income, then no loss can be set off, be it brought forward loss or unabsorbed depreciation. The assessee will not be eligible for set off, brought in by way of section 79A, new section. Now, long-term capital gain under section 112A is what is that? That is on which STT has been paid listed securities. Maximum surcharge can be only 15%, only on that long-term capital gain. Now the amount for an individual surcharge can be till 37%. Now the amended provision states that for any long-term capital gain, maximum surcharge can be only 15%. Forget about 112A alone. Any long-term capital gain, maximum surcharge can be only 15%. Similarly, surcharge is also reduced for cooperative societies. Now the cooperative societies surcharge would be at the rate of 7% if the income is between 1 crore to 10 crores. Earlier it was 12, now if the income is between 1 crore to 10 crores, it will be 7%. Similarly, for an AOP, that is Association of Persons, maximum surcharge is capped at 15%. Earlier it was 37, now it has been capped at 15%. These are some of the amendments that has been brought in the Income Tax Act. There are other amendments that we have got, like in section 147, that is in assessments there are amendments, in the time limits there are amendments, in section 263 we have got amendments, in charitable trust there are amendments, but wherever it is frequently seen or what is very important amendment is covered in this video. Thank you.